You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Hi, thanks for having me.
What's happening with the Dow? It seems almost every week either the S&P or the Dow hits a new record high. Is this going to continue?
Well, I actually think we've seen the bulk of the gains. We've been in this bull market since 2009, and it is something, when you turn on the TV and you see the NASDAQ above 5,000 and so forth, and that does generate big headlines and a lot of excitement in people. But in reality, if you look at what the market has done this year so far, it's only up a couple percentage points, and in fact, just a week ago it was in the red. So really, I think what's happened is the gains of the bull market were made years ago, and that was back when it wasn't making new highs and so forth, But since it's gone up for so long, without a bear market, people tend to think it can go on forever like that, and they are buying into it and so forth. But I really think at this point in time that, each day that the market goes, you're running the risk of getting closer to the next bear market cycle. And then, frankly, there's better places to put new money to work. And I would focus primarily on commodities because, as a whole, commodities have been in a bear market since 2011, and the CRB, Commodity Research Bureau Index, appears to be basing out and ready to turn the corner here probably by the end of the year. But what really has my attention is gold and silver. They tend to lead the action for the CRB index and go up first in a commodity bull market cycle, and they are in a better position to go up. Gold has to go above $1,300 an ounce to be clearly in a new bull market, but it's 150-day moving average now is around 1240. I think it's 1238 to be specific. So a breakthrough of that would be really positive development. We're below that now. I'm not saying this is going to happen this week or even this month, but I do think it can certainly happen this summer and certainly before the end of the year. So I think that's a more exciting place to be looking at than the Dow, going up today or whatever, even though it is, frankly, the Dow that has definitely captured the imagination of the people in general.
Are crude stocks a good idea right now?
I think at some point they will be. In fact, I'm looking to put a good amount of money to work there. But I think it's too early to do that. It's quite interesting that you asked that, because interestingly enough, that is actually what most people are doing with their money when they're buying stocks. And I say this because there's money flow data that shows that when investors are looking for new stocks to buy, besides some of the really popular ones like Apple that everyone feels like they must own, the other thing that they're buying are energy stocks. And they are attracted to energy stocks because most of them pay dividends. They're household names, stocks like Exxon, and they did fall last year. So there's a perception that, yes, the stock market may be overvalued, but energy stocks are not because they fell. Well, I want to dispel that because of two reasons. First of all, the price of oil is tied to the price of commodities in general, and in a commodity bull cycle, typically it's silver and gold and precious metals that go up first, and then other commodities go up one by one, kind of in a random pattern. So coffee may go up, grains may go up, cotton, sugar, and so forth, kind of in a random pattern, one after another, following gold and silver. But what's interestingly is oil tends to go up last in a commodity bull market. So if you think about the last time oil really, really went up and got people real excited, It was way back in 2007 when it went above $150 a barrel. Well, gold and silver have been going up for years, way before that happened. So I think it's going to be a long time before oil really takes off like it did in 2007. And we're going to see gold and silver go up first. And as evidence of that fact, I think people should, something people need to know is a year ago, before oil really tumbled, inside the futures market, commercial traders, which tend to be correct in the futures market, they had built up for themselves a record short position on oil before oil started to drop. They knew that drop was coming. In fact, it could be the case that they helped create that drop, particularly the oil sheiks and in Saudi Arabia. They knew it. They helped create it. And I would venture to bet that many of these people in Saudi Arabia helped create that net short position. Well, what I want to say is that they've only covered half of that net short position. So even with the knowledge of how commodities typically tend to move in a cycle, you got to realize that the guys that knew the oil drop was coming, they only covered half their short position. So we're not likely to see a real oil bull market take place until their short position is completely gone or they're even net long, and that's going to take some time to happen. Now, the second thing about oil stocks is that they are kind of trading also with the U.S. stock market and not simply with the price of oil. So if you look at what they've done since 2009, they really didn't trade the price of oil. The price of oil was kind of like going sideways up until this last summer, while the oil stocks went up at a 45-degree angle along with the S&P 500 and the Dow starting in December 2012, and then they collapsed. They began their collapse last year. So they're kind of caught up with action in the stock market just as much with action in oil. So I think people need to be very patient and not get caught up in trying to get in too early, and unless they're just going to average in, over, let's say, hey, I'm going to average in and just buy a little bit every month for the next 2 years, they'll be fine then. But people can't do that. They want to gamble it up. They want to go nuts, and that's why most people lose money in the financial markets, or don't do that well, I should say.
We'll have more with Mike Swanson right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mike Swanson from WallStreetWindow.com. Mike, what about the European and Asian markets? What's happening there?
Well, if you look at Europe, it's actually very interesting because Europe had a bear market a couple years ago that ended in 2012, and the European markets had a really nice rally. It ended last year in February, and then they fell into the end of this year. Now they're rallying back. So, then they started their quantitative easing program to help juice their stock market. So that's the game going on there. However, there are some markets in Europe that are very interesting. I'd like to point to the Russian stock market in particular, because it is still at a super low valuation. It's got a cyclically adjusted PE ratio of around 5, which a cyclically adjusted PE ratio, it takes the 10-year average of the PE ratio adjusted for inflation. The United States is trading at a cap ratio of 27, which the only time it's been higher than that was in 1999 and 1929. So that's the valuation of the U.S. stock market. But for comparison's sake, Russia's at 5. Most European markets are around 8, 9, 10. So yeah, they may go up some more. The Greek stock market, though, is an interesting thing to keep an eye on because it's the cheapest, the lowest valued market in the world. It is having its crisis. It's got a good chance it's going to default on its debt in the next couple of months, in fact. But whatever happens with the crisis, it's going to end one way or the other here. by the end of the summer. So once it does end, I think all the bad news will be priced in, and we should get a nice bounce, or at the very least, or a bottom that could be the bottom forever for Greece. So that's a market I'd really watch closely in Europe. And now with China and Asia, I gotta be honest with you, I traded Chinese stocks before. In 2009, I was playing Chinese stocks, making good money in them. The stocks were very volatile. They double, triple sometimes. But I was trading them. I didn't invest in them. In China, after that run I was in, China collapsed. And those stocks, a lot of them collapsed too. Some of them went bankrupt because they were scams. And that's what you got to face when you invest in China. Now, it's been the hottest stock market in the world the past couple of months, but you got to realize that it's a gambler's market, and you may be willing to jump out as soon as you buy or take your profits when you get them, and not think you're in some safe long-term investments, because that's not what China's about. That's pure speculation there. So, I'm not involved in it now. And I don't really know what it's going to do. I just want to tell people to be very careful there.
Mike, any word on the bond markets?
Well, the bond market may be the most fascinating market in the world, the reason why is people like to say bubbles. Bubbles is a phrase real common since 2009 or 1999, and I just said that the U.S. stock market's got a high valuation. But when people say bubble, they tend to think of not just a high valuation, but irrational investing behavior. So 1999 applied because people were buying internet stocks with no earnings and not caring what price they paid. I venture to say that type of behavior is going on in the bond market, because people are buying bonds in Europe now where they're getting negative interest rates. That means that they're paying the banks money to lose money. They're lending money knowing they're going to lose money. It makes no sense. It doesn't. Anyone listening to this show, if they want to lend me $100,000 and let them pay back $90,000, give me a call. But no one's going to call me. But there are people doing that in the bond market. That tells me that the bond market is totally imbalanced, and it's going to be a disaster on the reverse at some point. Bonds are at crazy valuations, and when that ends, that's going to have ramifications for the U.S. stock market. We've all been trained to think that interest rates are zero and they're going to stay zero forever. The Fed will keep rates really low forever. So therefore, the stock market's worth this valuation, and you can't get out of it because there's nothing else to do and all this. Well, it's all going to change one day when the bond market unwinds. And I'm not saying it's happening this week, but it's something we've got to be aware of.
Mike, thanks a lot for chatting with us.
Oh, thank you. Anytime.
My guest has been Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. Comments for the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.